Buenos días a todos los que estáis siguiendo o vais a empezar a seguir este Gas Market Report último cuarto del 2022. Encantados de teneros aquí de nuevo, y de nuevo tenemos con nosotros a Jean-Baptiste Dubreuil, que es el analista senior de la Agencia Internacional de la Energía, para presentarnos este evento que vamos a cambiar a idioma inglés porque es el que normalmente utilizamos en estos eventos. We're going to switch to English because we have here Mr. Jean-Baptiste Dubreuil. Thank you very much, Jean-Baptiste, for accepting to introduce to present this report. This is a good idea for the agency to share with all of us quarterly all this situation in the natural gas market. It's a pleasure having you here. Well, this is a very good report. I was telling to Jean-Baptiste is a holistic approach in this kind of theme for the natural gas. They are using this report to introduce all the aspects in the natural gas markets, the changes they are seeing in the market, the changes sometimes to going back to old times in several contracts, something like this, another changes like this analysis they are doing in the Global Gas Security Review 2022, with an analysis about the first quarter of 2023 too. This is very interesting to follow all of this. I think it's a pleasure having here aquí. He doesn't need a presentation from us. He's with us several times. Last time it was in May this year to introduce the second quarter or the forecast for the third quarter, I think so. Mr. Jean-Baptiste Dubreuil, I think Jean-Baptiste, as you know, you are going to introduce the report. After this, we are going to have a Q&A session. If you will have some question or something like this, you can put forward in the chat in Spanish or in English. We translate to pass to Jean-Baptiste. Now we are going to start with this presentation. Jean-Baptiste, the floor is yours. Okay.
Muchas gracias, Arcadio. Buenos días a todos. Un gran placer estar de nuevo con el Club Español de Energía por esta presentación. And now I'm going to switch to English, not to impose further my broken Spanish to you. A great pleasure to be there with you again, unfortunately virtually, but attending and presenting those latest market developments from the IEA Quarterly Gas Market Report. As you rightly mentioned, Arcadio, they're happy to go through some of the main findings of the report in that presentation. The report has a lot of matters being covered. It's about 100 pages long. It's fully and freely available on our website. So I'm just going to go through a couple of them, but please feel free to ask your questions after the presentation. I'll try my best to answer them afterwards. So without further ado, I'd like to start with a quick view on the price developments. This is something I guess everyone is familiar with, and we were discussing just before the presentation with Pablo and Arcadio. Energy is now everywhere, on the headlines, on the front lines. It's becoming a topical discussion in our daily lives. So there's more and more energy experts in Europe. Everybody is tracking very closely what's happening on the energy markets. And across the past months, as you can see, we have seen a very strong increase in gas prices in Europe, of course, but also in Asia. As you know, there's a very strong, intimate relationship between the Asian and the European prices because of that very strong tension on global liquefied natural gas markets, LNG markets, since the beginning of the invasion of Ukraine by Russia back in February. The prices reached in Europe, especially in Northwest Europe, in the TTF in the Netherlands, an all-time record at the end of August, close to $100 per million British thermal units, or about 340 euros per megawatt hour. Again, an all-time record, and standing somewhere between 10 times where they were a bit more than a year ago. If you look at the beginning of the graph, we started in June 2021, when prices started to increase after the strong recovery that we saw after the COVID crisis of 2020. So just to give a bit of perspective, where we're talking about the situation a bit more than 2 years ago, medium 2020, prices in Europe were at some point close to $1 per million British thermal units. And we're not talking about a bit more than a month ago, they were reaching 100. So that's the order of magnitude we're talking about in this very, very tight market across the globe. Prices have declined since then. Of course, the supply tension remains, but we've had very mild, unseasonably mild temperatures across Europe since the beginning of Q4, which has relieved some of the pressure on the prices. And also, Europe has very well performed in terms of its storage filling obligations, but I'll go back to that later on. What remains, in spite of the lower level of prices, that very, very strong level of volatility. In terms of time volatility, as you can see, there's a lot of ups and downs on those price curves, but also in terms of geographical spreads in between markets in Europe, which have spare capacity in terms of LNG receiving, such as Spain, such as France, such as the United Kingdom, and markets like the Netherlands or Germany or Eastern Europe, where there's no available LNG capacity. That spread is increasing or decreasing depending on the tension on supply. A quick word on the two other markets. You can see on this chart, the red curve shows you the spot prices, LNG prices in Asia. They've been also very high and volatile, but with a discount to the European prices most of the time. And in North America, the dark blue line that you can see at the bottom, the US Henry Hub price in the Gulf of Mexico, prices have been, of course, very much lower than what we've seen in Europe or in Asia, but they have nonetheless doubled since last year's summer. You can see almost tripled in the month of August compared to June 2021. We've had a very tight summer situation in North America, particularly in the power generation system. So all markets are in a very tense situation, which has, of course, repercussions on the physical flows. So we're now moving to the demand side, and this figure is probably a bit hard to interpret. There's a lot of information on the same figure, so let me try to disentangle for you. The four curves, colored curves, are the year-on-year evolution of demand on a quarterly basis for four big gas markets. So you have Europe, light blue, North America, dark blue, a selection of Asian markets in red, and Latin America in green. So you can read them on the right-hand scale axis, y-axis, in percentage. What we can see is that in most of those markets, with the exception of North America, as I said, there was a very tense situation in power generation. You still have some growth in North America. As you can see, it's a couple of percentage points positive in North America. We had something like close to 4.5% growth in Q1 and Q2 in North America. But North America is clearly the exception. If you look at the other markets, we're definitely in a negative trend. And when it comes to Europe, the trend is outwardly negative, with something close to 15% decline in Q2. Our estimate for the whole of this year is that Europe will be down by 9 to 10% compared to last year. The Now, if we turn that into volumes and plot together those four markets year on year in terms of quarterly change, that gives you the gray areas. You can see that in Q2 this year, 2022, we had lost something like 30-ish BCM, a bit more than 30 BCM in those four markets compared to last year, which is more or less the same as Q2 2020. You can see on the other side of the figure. But remember that Q2 2020 were a situation, an exceptional situation, where demand disappeared because of the lockdowns, the COVID lockdowns across the different market. And we're now talking about the more or less the same order of magnitude in terms of demand reduction or demand destruction. This time, not because of lack of demand, but because of lack of supply. So demand is going down. We're also seeing some strong switching away from gas with oil to gas switching, coal to gas switching. We see a bounce back of coal in Europe in power generation. We estimate that for the coming winter, there will be something like close to 0.7 million barrels of oil equivalent in oil products, additional demand that will come from switching away from gas in power generation industry. So this is a sizable impact. It comes across all of, if not all, most of the gas consuming markets across the globe. Europe, of course, sits at the epicenter of the crisis since the beginning of the invasion of Ukraine. We've had a very sharp decline in Russian pipeline flows to Europe. You know everything about it, so I'll go very quickly on that one. This is explained on the figure on left-hand side. You see that there's a very sharp decline, especially during the summer, with the progressive closure of Nord Stream and reduction in pipeline deliveries through Ukraine and suspension of delivery through Poland during the second quarter this year. So now we're seeing only about 40 MCM per day coming through the Ukrainian corridor and an additional volume coming from Turkey. But the supply to the European Union is more or less 1/5 of what it was a year ago. This has led to a major reorganization of LNG flows. You can see it on the right-hand side graph. We compared 8 months of 21 versus 22. I haven't updated it with the 9-month figure with September. It's more or less the same. The trend is further increasing. It's basically, you see that LNG trade increased by about 5% globally, with some new capacity being commissioned or returning to the market. But what is really striking is the expansion of Europe as a premium and preferred destination for LNG suppliers. European LNG imports increased by about 65% in this period compared to last year. That comes mainly at the expense of Asian buyers and particularly of Chinese buyers. This is what happens in Asia. This is what has been happening in Asia since the beginning of the year. So we're putting there the spotlight not on the overall LNG trade, but on that very specific fraction of trade that it's spot LNG trade, the one that is very flexible and enables to have this transfer from other regions to Europe. If you look at the envelope of spot flows to Asia since the beginning of the year, see that steep decline, and in particular that steep decline coming from China, which is the light blue area at the bottom of the chart. Chinese LNG, overall LNG procurement since the beginning of the year declined by about 22%, less than last year. But if you look at this particular spot part of the procurement, it was down by 60%, 60. So that's a very strong reaction from the Chinese buyers that has contributed to enabling more flexibility and more volumes coming to Europe at the rescue of that downfall in Russian pipelines. Of course, there was also some declines in other markets, particularly those price-sensitive markets such as India, Pakistan, Bangladesh, Southeast Asia. We've seen very steep declines. The worst one in terms of proportion is Pakistan. Something like 70% of procurement disappeared compared to last year in the first 8 months of 2022. And this is simply because it's not possible anymore to buy a cargo on the spot market at the current price levels for those price-sensitive buyers. So I'm going back to China. China is really the one of the big drivers of that reshuffling of flows. China, if you remember last year, 2021, China had become the world largest LNG buyer ahead of Japan, with over 100 BCM of procurement. This has sharply declined since then. And this comes from a very weak demand for gas we're seeing in China. This is on the left-hand side. That graph shows you the year-on-year change in monthly gas demand in China. As you can see, apart from a peak in the beginning of the year, we're trailing roughly below zero. So the overall gas demand so far in the first 9 months of the year, according to our estimates, is below 1% in terms of growth. And our best projection, we do not estimate that gas demand this year in China for the whole of 2022 will be above 2%. That's our upper limit, bearing in mind that when we published the report at the beginning of October, there were not still those new batches of lockdowns enacted. Because indeed, this is not only a question of price. What's happening in China is much broader than just price reaction, as we're seeing in Europe, we're seeing in other markets. Is also the whole slowing down of the Chinese economy, lower economic and activity and industrial production, and also the widespread impacts of the lockdowns and the zero COVID policy. So for 2022, we're in our, so to speak, optimistic view. We have put 2% increase and a potential rebound to 5% next year. Since then, IMF has downgraded its GDP forecast from both for this year and next year by close to 1 percentage point. So this is likely, of course, to have repercussions on the Chinese energy demand and gas demand. And of course, there's a big question mark on the follow-up on the lockdowns and the zero COVID policy. But by any means, even if we stick to that 2% target for this year, that would be the lowest gas growth rate ever seen since the mid-1990s. So that's close to 30 years ago. Is again putting, so to speak, a bit of relief into the market and additional volumes going to Europe. Now, in terms of overall LNG balance for this year, this is our view. We have, as you may know, if you read our quarterly reports, this is something that we update on a quarterly basis. Of course, with the lower flows from Russia, we have had to increase that increment of LNG, which is needed to balance the European system for the rest of the year. So our assumption is that for 2022, Europe would import 60 BCM more than last year. That you can see on the left. It has to be compared with what the market, the global market, can deliver in terms of additional supply. That's the dark blue bar in the middle. You can see that's less than 30 BCM. So it means that Europe additional needs is more than twice what the market can deliver on the supply side. Half of it comes from the United States, this additional volumes. The other half comes from other projects, most of them which were already operating, but with higher levels of deliveries. We still have a couple of question marks with the recent force majeures enacted in Nigeria and in Malaysia. Still difficult to put a number on those limits, but the market is running at close to its full capacity, and of course, any unforeseen event, either on the supply side or demand side, is likely to put further tension on that. One last thing about this balance, you can see that to go from close to 30 BCM of additional supply to that 60 BCM that is needed from Europe, someone needs to bridge the gap. That's actually the other buyers, mainly the Asian buyers, which are slowing down and declining from last year. We spoke about China. It's also the case for most buyers, including to some extent traditional buyers such as Japan, such as Korea. And also we're seeing from other regions, mainly from Latin America, after last year's very strong drafts during the summer, so the southern winter month, there was a strong increase for a need for LNG in Brazil to cover up for the low hydro. The situation was better this year, so this results in lower needs for LNG. But by all accounts, again, the situation is very tight, and any unforeseen event on both sides will likely further tighten it. In terms of demand, so again, lots of different information on that chart. You have the gray bars show you the increase in demand last year. So that's a very strong 100 and close to 170 billion cubic meters of additional consumption last year, 2021, 4.5%. So that's more than twice the demand destruction that occurred in 2020 because of the lockdowns. So that was a very strong, more than recovered, real jump in demand last year. What we're seeing this year, so the dots, the white dots give you the net growth for this year, for 2022, and the different color bars show you the sectoral contributions. So if you look globally, we're in for something like 0.8% decline, a bit less than 1% decline. Globally, that's roughly 30-ish billion cubic meters less than last year. As you can see, Europe is taking a very strong share in that decline. We have part of it coming from the industry, that's the dark blue bars, and it's coming from that price reaction. I've been talking about fuel switching, also of demand reduction, in some cases demand destruction, when factories are closing down permanently. We're seeing it in Europe. The other part is coming from residential and commercial. There is a bit of price reaction. There's also a bit of temperature-related decline. We've had a very mild beginning of the year in 2022 compared to last year, so that has led to lower consumption. For the other markets, I won't go through the whole of them, but one of the key findings is that Asia-Pacific, which was used to be the main engine of gas growth globally, is now coming to a halt. We're not seeing any growth, net growth, in the Asia-Pacific region. There's still some growth in major producing areas. In the Middle East, you can see, and in North America. In North America, it's mainly coming from power generation, as we're seeing a very tight situation in the US, and the impact of the phase out of coal in Western Canada, which is also pushing for more gas in the power generation system. Now, talking a bit about this winter, this was one of the focuses of this issue of the gas market report. Well, first coming with some, I would say, some good positive news. We are now in the first close to the end of the first month of the gas winter. And first, the temperatures are quite mild in Europe. And second, our level of storage inventory is very, very good. We are currently close to above 93% storage inventory for the whole of Europe, which was far from being a given. If you look at the situation of storage in Europe at the end of the past winter, so this is the central figure here. You see that back in March 2022, we were something like 10 BCM below the 5-year average for an overall capacity of 100, close to 100. So that's a major gap to fill in. And the industry was able to fill the gap during the summer, in spite of the high prices, to make that additional buffer from the storage available for the coming winter. If we're looking at the situation in other markets, on the left you have the US market, which is more or less you see in terms of overall volume, in terms of overall storage capability, the same amount. But the situation is quite different. We've had, again, a very tight summer balance in the US, which did not enable to inject sufficiently. So there has been a pickup in terms of injections since September and the beginning of October, but we are in an above average situation in the US. Of course, the stress on the supply is not the same as what we're seeing in Europe, but this may have some impact on the price level and the price volatility for US buyers. In Asia, we're seeing that the levels of LNG in tanks in Japan and Korea were well above the 5-year average at the beginning of summer. Since then, there have been some withdrawals from the Japanese utilities, but it's still standing as of mid-October above the average. One of the main points, and that's something that Arcadio mentioned, is introductions of, in this report, we have also the annual Global Gas Security Review, which is something that we publish every year after the summer. And one of the topics, of course, this year in terms of global gas security is the coming winter, especially the coming winter in Europe. And for that purpose, we have made a sensitivity analysis, a sort of business case. What happens if a certain number of factors combine, and how would the European system react and behave against the backdrop of a tense market? Further tense market, shall I say. First one is we assume a complete shutdown of Russian pipeline deliveries to Europe from the beginning of November. And then we have two cases in terms of deliverability of LNG to balance it out. High case, low case. What I'd like to go through is more the low case assumption that's on the right-hand side. And on the demand side, we have three different scenarios. No demand reduction compared to the 5-year average, 9% demand reduction, and 13% demand reduction. So the medium scenario is the 9%. That would be basically assuming that the demand reduction that we've seen so far in Europe is carried out throughout the winter. No demand reduction compared to the 5-year average is basically a proxy for a cold winter situation. 13% demand reduction is more or less reaching the European Union objective of savings for the winter. Face value is 15%, but some countries are a bit below. So if you aggregate, that's something like 13%. So basically, the dark blue is the business as usual, more or less, in terms of demand. Light blue is colder than average, and the green is more savings on the demand side. what happens is what we're looking at is what it means in terms of storage to face a potential late cold spell in the coming winter. So in March, if we have a new sort of beast from the east, like we had back in 2018, how much gas we would still have in the storage in Europe as a whole, in a case where there's no more pipeline gas coming from Russia and there's more tension on the LNG. So if you look at the results on the right-hand side figure in February, if we have no demand reduction, or if we have colder than average, we will be somewhere below 10% storage delivery, around 5%. So that's utterly insufficient to face a late cold spell. If we keep with the current 9% demand reduction, we'll be somewhere around 25% storage inventory as of February. And if we have a little more savings, that would be something like 33, 35, about a third of inventory capacity still in the tanks or in the underground reservoirs at the end, close to the end of winter. That's important in case of a late cold spell, but beyond that, every savings during the summer that would help sparing the storage will also help lowering the pressure on injection for next year, because next year we'll have to deal with the same constraints in terms of storage deliverability with much less Russian gas. Even if there is still some Russian gas, there will be a gap to fill in terms of deliveries compared to what we've seen this year. So, of course, the main message is demand side measures, policies to encourage saving during this winter will be of strong importance, not only to ensure that we safely go through this winter, but that we are collectively in Europe prepared as much as possible to go through the next cycle of injection and withdrawals for the European market. Now, looking a bit beyond this year and beyond this winter, we have updated our longer term perspective. And of course, this comes no surprise that what we're seeing this year will have longer term impact. So our previous medium term forecast was 1.7% on average to 2024. As you can see, that's already below what we've seen in the past years, including the decline in 2020 with the COVID crisis. What we have now as our base case to 2025 is 0.6%. So we've lowered it by more than 60% to take into account the impact of what we're seeing now on the supply side and as a long-lasting tension on the gas markets. It's a supply issue. Again, if you look at our perspective for gas production and supply growth for the near future, this year, of course, we're going negative because that negative chunk coming from Russia, that decline in Russian delivery, is not completely compensated by additional production from others. So we have a negative growth this year, and the next few years, it's rather modest in all cases, somewhere in between 1% and 1.5% in terms of supply growth. Some of it coming from export-oriented regions, especially from North America. Those are the red bars. And some of it coming from the Middle East, the orange bars, which is less exposed to exports. Apart from Qatar, the growth in production, whether it be in Iran or in Saudi Arabia, is mainly for the domestic market. One last point on supply is further bottlenecks down the line in terms of LNG. So it's not only a question of exploration and production slowing down and tensions with the reshuffling that occurred since the beginning of the invasion of Ukraine and Russia pulling out of the European market. It's also the fact that the LNG market is going through different cycles. We have an upper cycle in terms of new capacity, export capacity being delivered until more or less 2020. As you can see, those new capacities, which were mainly supported by Australia and the US, this new capacity were about 40 BCM. So something like 10% increase more or less year on year. Now we're talking about half of that. As you can see, until 2024, the average is less than 20 BCM. Still mainly coming from the US. But the big increase is not expected to come before 2025, 2026, with a flurry of new projects from the United States, with Golden Pass in the Gulf of Mexico, from Canada, and of course, that big orange area, which is the expansion of Qatar, expected by end of 25, beginning of 26. So looking only at the planning of those upstream projects, we're in for a tight market for a couple more years, if demand trends, of course, do not change radically. This has been translated in some changes on the LNG procurement side, and this is something that we track as part of our global gas security review. One interesting factor is, if you look at the left-hand side, is the destination flexibility. We make a very simple assessment because we don't have, of course, all the commercial and confidential information of the contracts, but depending on the features of the contract and who's buying, who's selling, we deem contracts to be more or less flexible. And until 2019, there was a majority of volumes which were FOB, so without any constraints attached to them. This has shifted dramatically to less flexible volumes. So we dub them as fixed destination. They may not be completely fixed as the old-fashioned contracts, but there's certainly less flexibility than what we've seen in the past. Another interesting feature, if you look at the middle chart, which is the contract duration, is we're shifting in something back to more long-term contracts compared to what we had back in 2017, 2018. So buyers are now locking in volumes, especially Asian buyers. Last year, 2021, China was the largest buyer, accounted for more than half of the volumes being procured on those new contracts coming from China. So those buyers, they are locking in volumes and reducing their exposure on the spot markets. One last thing with LNG is with the infrastructures. The reshuffling of LNG in favor of Europe since the beginning of the invasion of Ukraine by Russia has not only affected the cargoes, it's also affecting the availability of delivering through infrastructure. And this last slide provides a focus on floating regasification and storage infrastructure, which have become strategic infrastructure to procure on a tight market. If you look on the left-hand side, this is the count of vessels. We have about 20 vessels available or in the making on the market. That's the left column. The medium column shows you where those vessels are currently affected outside of Asia. You see that Europe, out of 20 vessels, Europe has already firm 12 vessel capacity for projects which are under development, plus another 9 vessels, which are not firm yet, but well advanced in the decision pipeline. So it means that Europe is more or less, the needs for Europe, more or less equating the capacity, versus a situation in South and Southeast Asia, where there was a lot of projects in the making, but only a few of them had secured their regasification infrastructure before the crisis began, before the invasion of Ukraine, before that major shift in volumes from Asia to Europe. So this translates on the right-hand side figure, in the list of projects, you see that there's some projects under construction, some of them planned, and if you sum them up, we're talking about more than 100 BCM of capacity. Question is, of course, if those projects are not attached to vessels which are already booked, there's a big question mark on their coming to light at any point. And what will it mean in terms of energy policy and energy transition in those countries in Asia? So very quickly, few conclusions. We are in a situation of very tight supply market with impacts on demand. We've seen a lot of demand reduction, some demand destruction. We're in for something like close to 1% demand contraction for this year. This has led to a major reshuffling of LNG trade. And the situation, of course, is very preoccupying at the beginning of winter, with a risk of further disruption from Russia. The role of storage is very important in that winter strategy, but demand savings will be also very important, whatever happens during this winter, to make sure that Europe spares as much as possible its storage capacity for the next winter. Thanks a lot for your attention.
Very much, Jean-Baptiste. It was a very, as I told them before, about the holistic approach in this report. You can download, all of you, this report for free in the web of the IEA. And I think you are not giving us a very bright future, no, with this resilience analysis and this increase in the supply of LNG markets. Jean-Baptiste, can you hear us?
Yes. Well, of course, the situation is not utterly optimistic.
Yeah.
We have nonetheless, there are some silver linings in terms of what Europe can do, what other markets can do to further accelerate their energy transitions. We have seen recently, no later than end of last week, the European Council resolutions to accelerate the deployment of renewables, energy efficiency, to develop new infrastructure, new solidarity among the different member states to increase the resilience of Europe.
Okay, as we promised, we are going to jump to the Q&A session. If you have some question, I saw 2 or 3 in the chat, and I'm going to give the floor or the word to Pablo de Juan to give you these questions.
Thank you, Arcadio. Thank you very much, Jean-Baptiste, for your presentation. Well, related to what Arcadio and you were just speaking, they're asking you what percentage of the gas currently stored in Europe came from Russia? How much is currently Russia? How much gas is Russia exporting to Europe? And then you already talked about it in the sensitivity analysis. Is how will Europe replace that gas for winter 23-24?
Thanks a lot, Pablo. Well, it's a bit difficult to allocate an origin of Russian gas molecules versus other origins into the different places, different storages. But basically, the calculation is that Russian gas last year was 110 BCM to Europe. It's now about half of it. And we do expect to see further drop for next year. Could be somewhere in between 30 BCM if we maintain the current ratio and extrapolate it to the whole of 2023, or down to 0 BCM if Russia decides to completely cut its supply. So we've had less Russian gas this year, but there's still some Russian gas, of course, in the system and in the storages. And this leads to a gap, further gap to be filled next year. So for that matter, I think it's both a question of supply and demand reactions. So far, Europe has been able to adjust its supply and switch away from Russian gas to other sources. We've had an increase in pipeline delivered by other suppliers, a major increase in LNG. There has been some demand reduction also, but next year this will have to go on to offset the further decline in Russian gas, make sure that our storages are still at a close to full level beginning of winter 23.
Okay, thank you very much. About China, they're asking you if you have an estimate for 2023 demand growth from China. They say in case there's no lockdown, which we hope there isn't. And then it says, considering that now there is more availability of LNG for Europe because of China's demand reduction, is there a noticeable risk of sudden re-increase in Chinese demand? And in that case, if the European Union is prepared for this situation?
Well, thanks. That's a very good and complex question. First one, China, again, the high price is part of the reasons why China gas consumption has been declining. But it's not the only reason. The GDP is very low. Last year, if I'm not mistaken, Chinese GDP was 8%. Now, according to the IMF, it's supposed to be 3% this year. They revised it down. The World Economic Outlook was published, I think, a week ago, and their previous assumption was 4.5%, and now it's down to 3%. Same thing for next year. It was something like 5%, now it's down to 4%. If you look at the macroeconomic indices, the PMI is not very good. It's below 50 in China. So industrial production is not likely to recover overnight based on those fundamentals. On top of that, there's the remaining uncertainty on the lockdowns. So I would say even in a world without the lockdowns, without the issue of high energy prices, it looks like the Chinese economy is already very weak. So that's a big question mark. Of course, Europe should not build its case for its energy security only betting on the fact that China will be weak or that we'll have a warm winter. That's not sufficient. That's not something that Europe can have a hand on. So for that matter, as I just said, I think it's a combination of further diversification of supply, but we're seeing closely the limits of it, and also some demand side measures to further increase efficiency, further deploy renewables, and mitigate the demand side of the equation.
Okay, thank you very much. Jumping to the US, they're asking you if considering the Henry Hub price evolution, not as high as in Europe, but still it says it almost reached $10 per million BTU this year, how likely can the country put in place some kind of LNG export restrictions?
Well, that's a topic that has been discussed before. Well, first, in the US, there's nothing like something like what we have in other markets. Like there is an integrated upstream downstream supply chain. All the US providers of LNG source themselves from the market, which means that they compete with the local buyers, but also means that there is no single supply chain. So the first thing would be, if there is a strong increase in prices, there would be less interest for the buyers to chip in additional volume. Second thing is, if there is a restriction, or if there were to be a restriction on the volumes, it would impact areas of production which are located especially in the Gulf of Mexico, whereas the production has now disseminated into several basins. It's not as located as it used to be. So the impact may not be the same. You may have some congestions in areas which are not connected with the LNG supply. So first, there is a political issue related to some export restrictions. Second one, it may not be as simple as reducing LNG exports would lead to change into availability of LNG for local consumers here and there.
Okay. Continuing with prices, they asked you from your first slide, when do you expect prices to start going up? And if you see volatility on prices, the new normal, they ask you.
Well, I don't have a crystal ball, and we don't do any forecasts. We're just looking at what happens on prices, and when we do those forecasts, we base ourselves on the futures curves. So those are quite volatile. I checked the latest prices and as at market closure on Friday, and for TTF, we were below $9. I think it was below $9 per MMBTU. So that's something like 30-ish euros per megawatt hour. But that's for day ahead. For month ahead, for November, which is coming very close, or December now, this had tripled. So there is an expectation from the market that the situation we're seeing now, which is an oversupply, because temperatures are mild, because there's almost too much LNG, and it's something that we're seeing particularly in Spain, with the planning of cargoes having to be rescheduled because of that oversupply of vessels against the capacity of regas terminal. This is not likely to happen. At least this is what the market believes. There is again a likelihood to have an increase during the winter months, but I guess that as for every winter there will be a very strong price volatility linked to temperatures, and that would be further increased by any event you have on unplanned maintenance for a pipeline, for an LNG terminal, or any signal from Russia to further decline its deliveries to Europe. So it is, again, this is not a prediction, but I guess that volatility this year, however the price levels will be, the volatility is likely to be very strong because the markets are very anxious.
Okay, thank you very much. Two questions concerning Russia. They ask you if where is the Russian gas that isn't coming to Europe? Is it going somewhere else? And then they ask you, from the perspective of Russia, will China gas needs offset the decline of European imports? I guess it's export.
Thanks. Well, at the difference of with coal or with oil, which can be easily shipped and can be, depending on the issues with sanction, can be redirected to other buyers. The situation with gas is a bit more complex because Russian gas comes mainly through our pipelines, and what is not delivered to Europe cannot be easily redirected to somewhere else. So there's probably some increase in domestic consumption, like increasing the use of gas for power generation in Russia and things like that. But the main outcome is lower production. And the Gazprom figures for last month in September was close to 40% lower than it was a year ago in September 2021. So that's the first outcome. Second one is in terms of reshuffling those volumes to the Far East and to China in particular. So last year, Europe was something like 115 BCM of Russian gas. Russia has a 38 BCM pipeline to China, which is fed by specific assets, production assets, which sit at the other end of Russia. to make this pipeline happen, the Power Siberia pipeline, it took 10 years of commercial negotiation plus another few years of construction. So even if there were to be an increase and speed up of the negotiation in between Russia and China, it would take several years before additional volumes would be shipped to China from Russian gas, whether it be from new assets that have to be developed in the east or connecting the assets in the western Siberia, which were delivering to Europe, and connect them to the pipeline system. So it's not instant reaction. Russia cannot swap volumes from the west to the east.
Okay, thank you. Concerning supply, they asked you what are the main reasons for the gas production reduction that you showed in your graph. They ask you if green finance has something to do with that. And also, what's your perspective on Africa and supply of gas coming from Africa, if you see it growing?
So the decline in production, there has been some debate on whether if investing in renewables was the reason why. And this is definitely not the reason why. Investment cycles in oil and gas are long-term cycles. And the project we're seeing now coming to fruition are projects that were decided 10 years ago. Thing is, 10 years, a little bit less than 10 years ago, 8 years ago, you had a strong collapse in oil and gas prices after 2014, and we had very low oil and gas prices in between 2015 and 2018, more or less. So this was not a time for investing in oil and gas. And this is the reason why we're not seeing more projects. This has nothing to do with investment in renewables, which is, by the way, if we hadn't invested in Europe in renewables, we will be in an even more tight situation because we wouldn't have those renewables capacity in the power generation system. With regards to Africa, there are some short-term fast-track developments. ENI is talking about increasing its deliveries of Algerian pipeline gas to Italy. Egypt is increasing its LNG volumes by reducing its own consumption, domestic consumption. And there are some projects in the pipeline. There is the first LNG export project in Mozambique, which is about to start. Another project, offshore project off the coast of Mauritania and Senegal, which is also expected to start next year, and a couple of more projects in the pipeline.
Okay, two last questions, Jean-Baptiste. What type of hypothesis have you been using in the resilience analysis that you showed for next winter?
Yeah, so first assumption on the supply is a complete cut of Russian gas, which is not a given, but that was part of the stress test. So assuming that from November 1st, there's no Russian gas delivered to the European Union. Second one is to which extent we would have additional LNG to compensate for that. So those are two subcases. And on the demand side, we had three levels of demand levels.
Okay. And last question, what's your point of view on the Council regulation that was announced last October 18th on the European Union's proposal for joint purchase of gas and the cap on prices?
Well, those are signs that Europe, as a single bloc and as the largest consumer importer of natural gas, is taking the issue in a holistic approach and altogether. This does not exclude national or measures or bilateral solidarity mechanisms that have been at play that we've seen. But the question of price has been debated among the different member countries. My understanding is it's still in the making in terms of what the European Commission is to propose with this corridor of prices that will enable to have a decent level of prices without disincentivizing deliveries from suppliers. There are also some alternative measures being taken by some countries like putting a cap on the level for electricity production, such as we have in Spain, or freezing the prices for residential customers like we have in France, or direct support to industries such as we have in Germany, for instance. So there's a wide array of measures that have been taken by governments. I think that this is going in the mandates that have been given by the Council to the Commission is going in the direction of further strengthening the ability of Europe to procure its gas.
Okay, thank you very much, Jean-Baptiste. We're done, Arcadio.
Okay, thank you very much, Jean-Baptiste. This is for this outstanding report and the outstanding presentation. I think it's cover up all the key issues in the gas natural market that has been changing a lot in the last years, no more or less. And thank you very much for that. I think you will be. I will expect you here in January, more or less, maybe for talking about the first quarter of the next year. If you are following this pattern in the IEA about the quarterly reports, ¿no? Muchas gracias a todos vosotros. Yo os recomiendo que lo podáis descargar. Se descarga, como hemos dicho anteriormente, gratis, y me parece un informe de los mejores. Thank you very much, Jean-Baptiste. Muchas gracias a todos. Buenos días.
Thank you.
Thank you very much.